Welcome to the deep dive. So right now, the market feels like it's navigating some, well, pretty rough seas.
Uh-huh. You definitely feel that.
Yeah, every headline seems to be about trade tensions, and you can almost feel the uncertainty hanging there for investors.
Absolutely. Some people are even using the word crash when they talk about sentiment, which is, quite strong.
It really is. But instead of just dwelling on that, we've got some pretty interesting analysis today. It's from mapsignals.com, dated May 5th, 2025.
Okay.
And the title is Buy Mega Cap Tech Stocks. So the core idea here is that even with all this market turbulence, maybe even because of it,
Right.
there might be some significant opportunities in these what they call beaten down growth areas.
And they're pointing specifically at mega cap tech.
Exactly. That seems to be a main focus.
Okay, so our mission for this deep dive then is to really unpack that view,
Yeah, let's get into the why.
to understand the thinking behind it. Why might now be a compelling time, according to this analysis, to look at these big tech companies.
We'll be looking at historical market stuff and the specific signals they're flagging right now.
Sounds good. Where do they start?
Okay, so the analysis kicks off by looking back, historical context, bull versus bear markets.
Right, the cycles.
And they don't pull any punches on bear markets. They call them brutal.
Well, they can feel that way.
Apparently, yeah. Since 1937 for the S&P 500, bear markets have averaged a hefty 29% decline.
Ugh.
And they last about 9 months on average. So yeah, definitely challenging for anyone invested.
That's a significant hit,
Yeah.
and it tests your resolve, for sure.
Yeah.
But what's the counterpoint they offer?
That's the key part. The analysis highlights that historically, bull markets kind of dwarf the bear markets.
In what way? Size? Duration?
Well, both, it seems. They cite average gains of 133%
Wow, okay.
over about 3.8 years on average.
So much bigger gains, and they last considerably longer.
Exactly. That really gives you that crucial long-term picture, doesn't it?
It does. So the main point they're making is that these downturns, as painful as they are,
Historically, they've set the stage for really big upward moves. They call them monster rips.
monster rips. Okay,
Yeah.
I like that. It implies a strong recovery.
Yeah. So the data suggests that while the immediate pain is real, the longer view shows these dips often turn into major growth periods.
And they have data to back that up further, like looking at a few years.
They do. They mention that if you look at the market, say 3 years after it first entered a bear market, historically it's only been down once in that time frame.
Only once across all those bear markets since 37.
That's what the analysis states. The much more common result is positive returns.
So for investors who didn't panic sell, or maybe even, bought the dip,
They generally ended up in positive territory a few years later.
that's a really powerful point about perspective, especially when things feel chaotic like they might now.
Definitely. It encourages you, the listener, to maybe zoom out a bit. Think beyond the day-to-day headlines and consider the historical context.
Right, don't just react emotionally to the short-term noise.
Ex-
Okay, so building on that idea of looking past the immediate market chatter, the analysis brings up something else.
Yes, they point to a really fascinating signal they're seeing right now in the credit and derivatives market.
Credit and derivatives.
Okay. And they suggest this could be, and I quote, a prime opportunity for the bold.
Intriguing. So what's the signal? Usually you'd expect trouble in credit markets before stocks, right? Like the canary in the coal mine.
That's exactly the typical thinking they reference. Credit markets often show stress first. Bond investors get nervous before equity investors, maybe.
So what's different now in 2025?
Well, according to this analysis, we're seeing the reverse, or at least a big disconnect. There's a much larger sense of panic in equities.
As measured by,
They point to the VIX index, the fear gauge.
right, volatility expectations.
Yeah, the VIX is showing a lot more stress compared to what they're seeing in the credit markets, specifically high-yield spreads.
So high-yield bonds, the riskier corporate debt, aren't showing the same level of alarm as the stock market volatility index.
That's the anomaly they're highlighting. The stock market seems much more panicked than the credit market right now.
Huh. That is interesting. Usually they kind of move more in tandem, or credit leads the worry.
Right, and this is where it gets really compelling. The analysis claims that historically,
Okay.
every single time before, when you've seen this kind of extreme equity panic relative to a calmer credit market reaction,
Every time.
according to them, yes, every prior instance was followed by the S&P 500 being higher 1 year later.
Wow. That's a pretty strong historical correlation.
It certainly makes you pause, doesn't it? Even if stocks feel shaky now, this relative calm in credit might be sort of a bullish underlying signal for the longer term.
Yeah, definitely something for long-term investors to chew on. They do emphasize it's not a short-term timing tool, though.
Correct. They're very clear this is about the longer view, a signal for investors, not necessarily traders.
Got it. So it's another piece of the puzzle suggesting potential future upside, despite current anxieties.
Exactly. Okay, so we have the history. Downturns often lead to big upturns. And we have this weird, potentially positive signal from the credit markets.
Right.
Now, let's drill down into their main recommendation, those mega cap tech stocks. The Mag 7.
The Magnificent Seven. We're talking Apple, Amazon, Alphabet, those kinds of giants.
Precisely. The analysis states these have been, quote, sold aggressively lately.
And they quantify that. How aggressive?
They do. They note this group, the Mag 7, saw a peak-to-trough decline of 33%.
33%. Okay, how does that compare to the broader market?
Significantly worse. The S&P 500 had about a 21% drawdown in the same period.
So these tech giants fell about 50% more than the overall market index.
That's the math, yeah. Quite a drop.
But the analysis sees this not as a warning sign, but as an opportunity.
That's exactly their angle. They
Right.
call it a magnificent opportunity, actually, creating some potentially juicy deals.
Okay, juicy deals. So why? Why are these companies potentially attractive after such a fall? Are they resilient?
That's part of it. They argue that despite, some tariff exposure maybe, their dominant market positions and, crucially, their strong balance sheets make them pretty well equipped to handle economic weakness.
Better than most companies, probably. They have pricing power, lots of cash.
Right. But here's the kicker, really. It's about the earnings.
Okay, what's happening with their earnings picture?
This is where it gets really interesting. Despite the stock prices getting hammered,
Yeah.
the Mag 7's consensus 12-month forward earnings expectations have actually been revised upwards.
Upwards, while the stocks were falling.
Yep, by a pretty significant 14.7% so far this year.
14.7% up on forward earnings estimates. How does that compare to the rest of the market?
It's a huge difference. The overall S&P 500's forward earnings are up only about 5%.
Okay.
And if you look at the S&P 500 Equal Weight Index, which reduces the influence of these giants, its earnings revisions are up only 0.5%, basically flat.
Wow. So the underlying business outlook for these huge tech companies is actually improving substantially, much more than the average company, even while their stocks got hit harder.
That's the picture the data paints, and it continues looking forward. For the calendar year 2025, the consensus forecast is for 15% earnings per share growth for the Mag 7.
15%. And the rest?
Compare that to just 8% expected growth for the S&P 493, that's the S&P 500, without those 7 companies.
So almost double the expected earnings growth rate compared to the rest of the market.
Pretty much. So you've got much faster expected growth.
And yet their stocks fell more. That does sound like a potential disconnect.
Exactly, which leads to the valuation point.
Right. Have they gotten cheaper?
Significantly so, according to the analysis. They look at the 12-month forward price-to-earnings ratio.
The PE ratio, yeah.
It peaked at around 36 for mega cap tech back in February,
Okay, quite high.
and now it's down to 25.6.
So a big compression in the valuation multiple. They've been marked down more than the overall market on that basis, too.
That's what the analysis indicates, yes.
Okay, so putting it all together, strong companies, leading positions, improving earnings outlook, faster expected growth than the market, and valuations that have come down significantly more than the market.
That sums up the core investment case they're presenting pretty well. It sounds like, the fundamental ingredients are there.
It certainly seems like a logical argument based on those points.
Yeah.
And they wrap this up neatly.
Yeah, they distill it into what they call a simple playbook. 4 main points.
Okay, let's hear them.
First, don't be fearful during a bear market. Easier said than done, maybe, but based on history.
Right. Principle 1, manage fear.
Second, recognize that this big gap oversized equity stress versus credit stress often comes before big stock gains.
Okay, watch that signal.
Third, focus on high-quality companies, specifically ones that reliably grow earnings faster than the overall market.
Quality and growth. Makes sense.
And fourth, maybe consider companies that institutions favor, the big funds, often a sign of quality and staying power.
So look where the smart money is, perhaps. It's a pretty straightforward framework.
It seems like it, though, like we said, sticking to it during volatile times is the tricky part.
It really highlights that need for a long-term, data-driven approach rather than just reacting to the noise.
Absolutely. So let's just quickly recap this deep dive.
Okay.
We looked at the history. Bear markets are tough, but bull markets afterwards have historically been much bigger.
Check. Don't forget the monster rips.
Right. Then there's this unusual current signal. Stock market stress seems way higher than credit market stress, which historically has been bullish for stocks looking out a year.
Got it. The equity versus credit divergence.
And finally, the specific case for megacap tech, they got hit hard, but their earnings outlook is strong and improving faster than the market, and their valuations look more attractive now.
Yeah, the combination of those factors, the history, the current signal, the specific company fundamentals that builds their case.
So the final thought for you, the listener, is really, considering all this information from the analysis, what does this historical pattern, this specific market signal right now, suggest about your own long-term investment view, and maybe about potential opportunities in tech?
It definitely gives you something substantial to think about, particularly if you're navigating these uncertain market waters.
Indeed. Thanks for taking this deep dive with us.